So, you want to buy a data center. Most people think this business is about servers. It isn't. It's about a substation. Here's the number that explains everything else in this video. In 2020, a standard data center cost about $7 million per megawatt to build. In 2026, that same megawatt costs $11.3 million. Optimized facilities, the kind built for GPU clusters, run $20 million to $37 million per megawatt once you add liquid cooling and tenant fit-out. A single gigawatt AI campus, and several are now under construction in the US, costs $45 billion to $55 billion. That's not a typo. That's roughly the GDP of Bulgaria spent on one building. But before you write that check, let's talk about the cheap way in, because like every business in this series, there's a small-time entry point most people never hear about. How much does it actually cost to get in? At the bottom of the market, edge data centers, small modular facilities serving latency-sensitive local traffic, can be deployed for $5 million to $15 million and be operational in 6 to 12 months. You won't be hosting anyone's AI training run, but you'll be leasing rack space to local businesses, hospitals, and telecom providers who need compute physically close by. One tier up, a standard shell and core wholesale facility runs $10 million to $12 million per megawatt. A modest 5-megawatt building, the kind that serves a mid-sized colocation tenant, lands around $55 to $65 million all in. At the top, you're not buying a building anymore, you're buying a small city's worth of electrical infrastructure. Meta's Hyperion campus in Louisiana covers 3,650 acres and will draw more power than the entire city of New Orleans. Companies like OpenAI, in partnership with Oracle and SoftBank, have committed to a project called Stargate with a headline figure north of $500 billion in planned data center capacity by the end of the decade. Here's the thing that trips up first-time buyers. None of these numbers include land, permitting, or the actual computers. They cover shell, power, and cooling only. The GPUs are a separate, and often larger, line item that ages out of usefulness in 3 to 5 years, which means unlike a McDonald's or an airport, a chunk of what you bought starts depreciating before you've even opened. The licensing problem nobody warns you about. There's no FDIC-style charter for opening a data center. The real gatekeeper is the electric utility. In Northern Virginia, home to the densest concentration of data centers on Earth, the local utility Dominion Energy has placed a moratorium on new large power connections. In parts of the PJM grid region, the interconnection queue, literally the waiting line to get plugged into the power grid, extends into the 2030s. This has quietly become the actual barrier to entry in this industry. In a 2026 survey of data center owners by Mortenson, only about 3% of operators ranked tax incentives as their most important site selection factor. What actually decides where a data center gets built isn't the tax break. It's whether the local grid has anything left to give you. The official business, and the real one, officially, a data center rents you space, power, and cooling so you can run your own servers. This is called colocation. As of late 2025, U.S. wholesale colocation, large blocks of committed power, typically 250 kilowatts and up, averaged $195.94 per kilowatt per month, up 6.5% year over year, in a market where vacancy in primary hubs sits below 1.5%. On top of that base rate, electricity is billed separately as a pass-through charge, meaning you, the operator, take zero risk on rising power prices. Your tenant eats it. Retail colocation, smaller deployments for enterprise customers, prices even higher. A single cabinet with 5 kilowatts of power in a top-tier market like Northern Virginia or Silicon Valley rents for $1,500 to $3,000 a month. Push past your allotted power and the overage rate jumps 20% to 50% above the standard price. You are, in effect, running a landlord business where the tenant has nowhere else to move, because there's nowhere else with spare power to move to. The second, higher margin business is interconnection. Equinix, the largest colocation operator on Earth with roughly $9.2 billion in 2025 revenue, doesn't just rent space. It operates buildings where internet providers, cloud platforms, and banks physically plug directly into each other via dedicated cables called cross-connects, bypassing the public internet entirely. Every cross-connect is its own monthly fee, and unlike raw rack space, this line of business has no meaningful marginal cost once the fiber's laid. It's the mall rent and parking fee equivalent from the airport playbook, except your foot traffic is fiber optic. And then there's the newest and strangest revenue stream, selling your own future capacity before you've built it. Hyperscale tenants, Microsoft, Amazon, Google, Meta, OpenAI, now routinely sign 10 to 15-year leases on data centers that don't exist yet, locking in power and space years in advance because the alternative is having no facility to move into at all. You get paid before you pour concrete. What it costs to keep the lights on. Literally, a large hyperscale AI data center can draw as much power as 100,000 homes. Meta's planned Wyoming facility will use more electricity than every household in the state combined. Electrical systems eat 40% to 45% of total construction cost, and that same intensity carries into operations. Labor, cooling, and above all power are the three permanent costs that run whether or not a single customer signs a lease. Then there's water. A large data center can consume up to 5 million gallons of water a day for cooling, roughly what a town of 50,000 people uses. Around Phoenix, existing data centers already draw about 385 million gallons a year, and that figure is projected to rise to 3.7 billion gallons annually as planned facilities come online, an 870% increase in one metro area. Some operators, like Microsoft, have started deploying zero-evaporation liquid cooling to cut this exposure. Others haven't bothered. The shadow economy, tax breaks, gas turbines, and angry neighbors. Here's the part of this business that doesn't show up on the pitch deck. For a decade, states competed to hand data centers the most generous tax breaks in the country. 38 states currently offer dedicated data center tax incentives, mostly sales tax exemptions on servers, generators, and cooling equipment. In 2026, the bill for that came due. Virginia is giving up about $1.6 billion a year in tax revenue to data centers. Georgia's exemption is projected to cost the state $2.5 billion this fiscal year alone, a 664% jump from the prior estimate. Texas is losing over $1 billion a year and rising. Indiana handed a single package worth an estimated $8.2 billion, mostly to Amazon. The backlash has arrived fast. In 2026, Illinois paused its incentive program, Arizona enacted a 3-year moratorium, Ohio froze new applications, and a California city called Monterey Park became the first in the U.S. to ban new data center construction outright, with 88% of voters in favor. The reason isn't abstract. It's showing up in mailboxes. A Virginia homeowner featured in a 2026 Consumer Reports investigation watched his electric bill jump from about $100 to $281 in a single month, and pointed directly at the data center boom pushing demand onto a grid that wasn't built for it. Then there's the scandal end of the spectrum. In Memphis, Elon Musk's eye ran dozens of unpermitted gas turbines to power its Colossus data center, built to train the Grok chatbot. Thermal imaging identified over 30 turbines running without air permits in a majority black neighborhood already given an F grade for smog by the American Lung Association. The NACP sued under the Clean Air Act. In 2026, the U.S. Department of Justice intervened on Zay's side, arguing the turbines were a matter of national security because Grok reportedly supports Defense Department operations. The case is still working through federal court as of this year. It's the same math Blackwater ran with contractor deaths. When the externality lands on people with no seat at the table, it's cheaper than compliance until it isn't. Run the math. 3 versions of your data center. Option 1. A small edge facility. Build cost around $10 million for a 1 megawatt facility. Colocation revenue at roughly $196, a fully leased 1,000 works out to about $2.35 million a year, plus electricity pass-through that covers your power cost, but isn't profit. After staffing, maintenance, and debt service, you're netting somewhere in the low hundreds of thousands annually. You're not buying this for cash flow. You're buying it for the land, the interconnection rights, and the option value if a hyperscaler needs your grid slot later. Option 2. A mid-size wholesale facility, 20 megawatts. Construction runs roughly $220 million at 2026 pricing. At $196/leased, that's about $47 million a year in gross colocation revenue. Strip out power pass-through, revenue neutral, staffing, maintenance, insurance, and debt service on a build this size, and a realistic net margin lands around 30% to 35%, roughly $14 to $16 million a year in profit. Payback on construction cost alone, 7 to 9 years, matching industry break-even benchmarks for build versus lease decisions. Option 3. A hyperscale AI campus, 200 megawatts. All-in cost at AI-grade specification, $4 to $7 billion. Leased entirely to a single hyperscaler on a 15-year term at wholesale AI rates. Annual revenue lands in the $400 to $500 million range. After power, staffing, cooling, and heavy depreciation on GPU-adjacent infrastructure that ages out in 3 to 5 years, net margins for pure-play REIT operators like Equinix and Digital Realty run in the 25% to 35% band. Call it $120 to $170 million a year in profit, once fully ramped, which itself can take 2 to 3 years post-construction. The catch at every tier is the same one that killed Silicon Valley Bank: concentration risk. Equinix serves over 10,000 customers. A 200-megawatt hyperscale campus, by contrast, often serves one. If that one tenant's AI bet doesn't pan out, and several analysts in 2026 are openly asking whether hyperscaler CapEx has outrun actual AI revenue, you're not holding a diversified cash flow machine. You're holding a single tenant building the size of an airport, built for a customer who's rethinking the lease. An airport owns the door people walk through. A bank owns the ledger people's money sits in. A data center owns something more fragile than either: a slot on an electrical grid that governments are now actively deciding whether to keep subsidizing, and a tenant whose only real estate need is speed, which means the day a competitor's grid connection comes online first, your slot isn't special anymore. It's just a building full of chips that are already 3 years old.